Lesson 2. How to quickly and effectively identify the trend. The very first step to a good trade is to identify the trend. The reason for this is that you want to always take positions in the direction of the trend, where the main energy is. Why? For obvious reasons. A trend is a period in which prices move persistently in one direction. So if you want to be in a trade that will be persistently moving in your chosen direction, you have to be with the trend. You have to know if the trade is up, down, or sideways. If the trend is up, you want to buy. If the trend is down, you want to sell. If the trend is sideways, as it often is, you want to stand aside and wait until an up or down trend starts again. The trick is, how do you identify the trend effectively at the earliest possible stage? The traditional definitions of trends, such as a succession of higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend, won't help you much. So we should find a quick way to identify the trend unequivocally, and there are many ways to do so. In our courses, we deal with many analytical tools to help you in such a task. We use trend lines, Elliott waves, moving averages, price patterns, bar patterns, candlestick charts, Ichimoku clouds, and others. Some traders will argue that identifying the trend is easy. One must just look at a chart. If prices go from the lower left corner to the upper right corner of your screen, you can say that you are in an uptrend. In this chart, you can see such an example. Prices started in the lower left corner of the chart and continue moving higher towards the right upper corner. Besides, it is possible to draw a 45-degree trend line which clearly defines the trend as up. Conversely, if prices decline from the upper left corner to the lower right corner of your screen, you are in a downtrend. But this approach to identify the trend is not always of great use to a trader. While we can expect prices to continue higher, at least until the trend line is violated, this approach requires a lot of data before taking a decision, which is a major disadvantage. Often by the time you're able to identify the trend in this way, the trend is already established and has gone far enough. Typically, it's too late to enter a position in the direction of the trend after identifying the trend in this way, because a reversal or even a trend change may be about to start. Granted, that's not always the case, but the trend can often go longer than we think or expect. Yet, for the purpose of our top strategy, we prefer the use of an even simpler way to identify the trend. We call it the mathematical way. Throughout our entire program, you'll be able to learn all about trends in our technical analysis section. That way, you'll be able to create your own trading strategies by combining some of the different methods of trade recognition that you're going to learn. But for now, let's explore the mathematical way to identify the trend. It's fast, easy, and effective. A moving average is a mathematical calculation that defines the trend without subjectivity or confusion. Its slope says it all loud and clear. If we simply place a moving average on our chart and observe the direction of its slope, we will be able to quickly and easily define where the trend is. But of course, we need to decide what period and type of moving average to use. So for our dual frame top strategy, we recommend the use of a 30-period weighted moving average. There is no mystery with the number 30. It is just the period we have observed throughout the years that works consistently well with the DFTS. A weighted moving average is not much different than a simple moving average. But for the purpose of our strategy, it works better because it assigns heavier weighting to more current data. On this chart, I am showing you a simple moving average just so you can see how simple it could be to identify the trend this way. Notice how when the slope of this moving average goes to the downside, the market moves persistently to the downside as well. So we can easily conclude that the trend is down. However, in the middle of the chart, the moving average flattens and the market moves sideways. Once the slope of the moving average turns up, prices start moving persistently to the upside, clearly indicating that we are now in an uptrend. As you can see, using a 30-period moving average as a guide to identify the trend is easy and truly effective. It does not require any interpretation. But let's be honest. It's difficult to take trade decisions only based on one moving average. That's the reason why so many trading systems use 2, 3, or multiple moving averages in order to pinpoint safer trade signals. And even then, these systems are notorious for false trend reversal signals. So in our dual frame top strategy, we will use only the 30-period weighted moving average in conjunction with the top indicator. The sole purpose of the moving average will be to help us identify the direction of the trend. Notice how when price moves below the moving average, prices tend to fall. And when prices move above the moving average, prices tend to rally. Simple, but not enough. I wish trading would be as simple as this, but it isn't. So why not? Because during sideways periods, like in the middle of the chart, prices will be moving above the moving average and fall back again, or fall below the moving average and rally again. Unfortunately, sideways trends occur more often than up or down trends. Hence, often we have to take the aid of other indicators that show us ideal places to enter and exit the market. So in the next video, let's explore a little bit more about indicators and their use.